Okay, guys. Okay, I'll start now. All right, so thank you guys for joining me today. I think I'll start off with chapter one. Okay, we'll go through fundamentals first. So from here, we're gonna start off with our fundamentals. Those of you guys who has been trading for quite a while, most of you guys might not have, you know, relook at your fundamentals for quite a while. So this will help you to brush up on what you guys might missed out on years ago when you guys started trading, right? And it's very, very important to understand your fundamentals. Okay, so moving on. Before we start, all right, I know most of you guys here has been trading or have been into trading. So one question for you guys can reply inside the chat room. So are you looking to trade Forex because you think that trading is going to get you rich quick? So how many of you guys here look to trade Forex because of thinking that you guys can get rich quick? It's okay. You guys can, go ahead and be honest, right? So for me, same thing. I started trading Forex because I was watching those YouTube video, TikTok video, thinking that trading Forex is gonna make me a millionaire, right? So obviously that's not the case. In fact, it's gonna be pretty the truth, right? Yeah, so you guys have probably went through all of this, trading. The truth is that trading is not a get rich quick scheme. Number one, you will have years of failure, self-doubts, and also deterrence by our loved ones. And of course, definitely busting multiple accounts. Before I even start becoming consistently profitable, I bust like 10 accounts or 13 accounts before I even become profitable, right? So when the truth strikes you is when you start to get demoralized, right? Keep feeling, seeing that you have been lied to, right? The feeling. And then after that, this is why with our mindset, we need to understand first that trading is not a get rich quick scheme, right? It takes years of practice, like businesses, right? Money isn't easy to earn. If it's so easy, everyone will be doing it. Okay. So what is the Forex market all about? So for those of you guys who are beginners here, you guys should understand that Forex it means foreign exchange or FX trading. It's a conversion of one currency into another. And one thing about Forex market is the world largest and most liquid market, right? But this is a thing that you guys might not know, is that the market is denominated by the US dollar. So this is why sometimes you see pairs like, XAUUSD, Euro USD, GBP USD. They tend to be more liquid because the whole market is mostly denominated by the US dollar. So pairs trading with the US dollar is usually more liquid. Okay? Okay. So do you know that the Forex market is actually have an average volume of $6.6 trillion traded every day? So even if you are a billionaire and you inject $1 billion, it's not gonna move the market, right? So because every single day we have $6.6 trillion traded, even if you are a billionaire, you're not gonna move the market with like 1 million, 2 million, $10 million or $100 million. People inject billions of dollars, hundreds of billions of dollars in order to move the market. And as you guys know, who controls the market, right? So we have our US banks and our central banks, they take up about 70% of the market share. So hedge fund takes up about 10% and institutions takes up about 15%. So where are we? We only takes up maybe 5%. We are the retail trader, right? So out of the whole 100% pie of the market share of this $6.6 trillion, we controls only 5%. So this is why it's very, very hard for us to move the market and this is why you guys get manipulated, right? And of course, most of you guys ask what's the difference between the Forex market and the stock market. This is just simplified, right? Your Forex market, if you guys do not know yet, it's not just currencies trading, right? For those of you guys who are new to Forex trading, if you guys realize on your brokerage, on your MT5, MT4, there are many instruments, right? You guys can trade not only currencies, your commodities like metal, like gold. You can also trade indices and crypto. So do you guys know that you can actually trade crypto and indices or even gold or metals in Forex market, right? And this also allows you to have a variety of instruments to trade, not just your currency pairs. When it's also technically a 24-hour market, there's only a 2 hours break, Monday to Friday. And compared to stock market, right, you buy and sell shares of a company and market only opens for 8 hours window. And obviously, so this is very important to understand. Your Forex trading volume, okay? This is a fundamental that many people don't understand, is that the USD takes up 50% of your Forex trading volume. So pairs with USD behind, like XAUUSD, Euro USD, GBP USD, have more liquidity. And then the euros, right? And then Japanese yen and other currencies makes up 20%. So sometimes you all realize that when you guys trade those weird pairs like New Zealand dollars, maybe all those Canadian dollars or Singapore dollars, Malaysian dollars, right? You guys don't see a lot of liquidity. You tend to get trapped within this price range because the trading volume is mostly denominated by these three currencies: your Japanese yen, your euros, and your USD. These pairs are the more volatile and liquid pairs. Okay. Okay, now we're going to talk about some simple technicals, but it's more of a basic. So if you guys understand already, so bear with me for those of you guys who already understand it, right? So how do we read Forex codes and pairs? How to count pips, understanding leverage, and also how to analyze the market. Okay, so how to read Forex codes and pairs? Many of them, or many of the traders I know who have been trading for 1 year, 2 year, right? They still don't understand how to read pairs. Okay, so based on it, back to the basics, we have to understand that a forex code is the price of one currency in terms of another, right? So you always see two pairs, like maybe your euro USD, right? Okay, so this is always in terms of one currency against the other currency. So it's what does it mean? So it's always buying one currency and selling the other. So this is your fundamentals that you should know. So when you're trading the euro USD, let's say you are buying euro USD, that means you're buying the euros and you're selling the US dollar. So if you're selling euro USD, you're selling the euro and you're buying the USD. Okay, this is a very important fundamental that you guys need to understand as well. Okay, so 5 simple steps on how to read Forex codes and pairs is that number one, you have to identify the pair that you guys are trading on. So many beginners or even traders who have been trading for quite a while made the same mistake of trading too many pairs at the start. So you guys tend to, have trading maybe 5 instruments or 5 pairs, 6 pairs at the start, right? So you have to identify what pair do you want to focus on and choose one pair to focus on first when you are beginning in Forex. Okay, master that pair first. Okay, next, number two, what we want to look for is to look for your base currency and your quote currency, right? Do you guys know what is your base currency and what is your quote currency? Okay, so very simple. Your base currency is always the first in the pair. So this is your base currency. All right, so I just put it as B. All right, your quote currency is the second currency. All right, this is your quote currency. So same thing, right? So let's say we have maybe XAU USD. So do you know how do you read this, guys? So XAU USD, you guys will see that this is gold spot against the US dollar, right? So which is your base currency? In this case, it's not a base currency, right? But this is your base. So this is your B. And this is your quote currency, which is your US dollar, right? So how do you guys read this? So this is basically 1 ounce of gold against the US dollar. Same thing. Your base currency is always denominated as 1, right? So 1 to how many? All right. Okay, next. You guys have to understand the bid and ask price and also understand what is spread, which we will be going through later on. All right. Okay. First, we'll go more in depth into this. Okay, number one, you have to identify what pair you are trading. So example, you want to trade the euro against the US dollar. You have to understand that you are buying euro and selling the USD. Same thing. If you are trading XAU USD, which is gold, you are trading gold against the US dollar, right? You are buying gold and selling your USD. Same thing, right? GBP, JPY, you're buying GBP and selling the yen. So these are all fundamentals that you guys have to understand before even going into trading. All right, number two, how do you guys look for the base and quote currency? So the base currency is always listed first. In this case, let's say for Euro USD, right? The value of the base currency is always expressed in terms of the quote currency. What do I mean? Okay, so for example, in the pair Euro USD, the euro is the base currency and your USD, the second quote, the second one in the pair is always your quote currency. Okay, in this case, it's the US dollar. So your base currency is always valued at 1. So it's always 1 euro is equal to how many USD? All right, this is why it's called the quote currency. Okay, so sometimes if you guys don't understand what does, maybe your Euro USD, if let's say it's 1.1404, so maybe you guys see this like Euro USD, right? And then they says that the quote value is 1.1404, right? So many of you guys don't know what it means, right? So this actually means that 1 euro, which is your base currency, is equal to 1.1404 USD. So with 1 euro, you can buy 1.1404 USD. Okay, up to this point, let me know. Do you guys understand or am I going too fast? You guys can type in the chat whether I'm going too fast or understand. Okay, so now you have your base currency, same thing. Okay, so now XAUUSD is the same thing. So one ounce of gold can buy how many USD? So that is your quote price. Okay, next, understanding your bid and ask price. I think this one you definitely know your sell and your buy price. I'll skip through this. Okay, what is spread? For those of you guys who are new here, sometimes you guys will realize that once you get into a trade, you immediately have a loss, right? This is what we call spread, because this is what your brokers take for their commission for executing a trade on your behalf, right? So this is basically your spread. Okay, so as you guys can see, went to look for an entry. Number 5, okay? So Euro USD. So you guys have to understand the correlation, right? So when you're trading USD, if you're expecting that the euros are going to grow stronger, right? So you're expecting the pair trading against the euro to go up. So let's say Euro USD, right? If the euro go up, this pair will go up, right? If the euro go down, the quote price of the pair will go down, right? This is correlated to one another, right? One another. Okay. Now, how do you count pips? Do you guys know how to count pips? So this is a lot of beginners have the same confusion. How do you count pips? How, because it's pretty hard, right? Because different pairs have different way of counting pips. So you guys have to understand what does pip means. So a pip, which basically means point in percentage. This is what the unit measure used in by Forex trader to define the change in value between currencies. So if you guys realize different currencies pairs have different way of counting pips. So let's say for gold, right? So gold, 2000, let's just say 2000. Gold is at 2000, right? Okay. So most of you guys should be probably is trading gold. So now let's say gold is trading at 2000. So what does this mean? So this is your base and this is your quote. So this is 1 ounce of gold. The base is always denominated as 1. So 1 ounce of gold is equal to 2000 USD right now. All right. So what does it mean? So let's say if gold move from 2000 to 2001. So how many pips is this? So how many pips is this? How many pips is this? So yeah, this is 10 pips, right? So every so-called 1 USD move for gold is 10 pips, right? So 0.01, this is a move of 1 pips. Okay, so this is for gold, right? But what about currency pairs? So if you guys realize about currency pairs, there's different thing, right? Like maybe your Euro USD, right? 1 euro to USD, right? It's a different way of counting pips as well. Maybe 1 euro to USD is 1 euro is equivalent to maybe 1.14, right? 10. So how do you count the pip? Which one is the pip? So usually for pairs, simplified for you guys, okay? For pairs trading against the US dollar, only for currencies, right? 1 pip is for the fourth decimal place. All right, so let's say from 1.1410 to 1.1411 is a 1 pip movement. All right, make sense? Okay, this is only for USD pairs. So let's say for GBP JPY, there's a different way of counting pips as well. I'll just go through the more common pairs, right? So let's say your GBP JPY, let's say it's at maybe 181.500. So how do you guys count 1 pip? GBP JPY is easier to count as well, because let's say from 181.5, it goes to maybe 181.6. This is a 10 pips movement. All right, 10 pip. Okay, so this is just for the more common pair. So for your gold, 1 pip is the second decimal place. Sorry, 1 pip is the first decimal place, right? So 2001.1. Okay, this is 1 pip. And then 10 pip is from 2000 to 2001. This is 10 pip. All right, same for GBP JPY. The first decimal place and 1 increase is 10 pip. All right, but for your currency, which is different, the currency pairs, let's say for those Euro USD, GBP USD, you will see that there's a lot of decimal place, right? So currency pairs trading against the USD, you take the fourth decimal place as 1 pip. All right, up to this point, do you guys have any questions regarding how to count pips? I will not go through every single pair because there's too many pairs to count. I'll just go through the more common ones. All right. So for those of you guys who don't know this, you guys can use this to calculate your pips, right? This link here. You guys can copy and paste. It's a free pip calculator. All right, next, we are about to finish the fundamentals already, okay? Hold tight. All right, so now we are, what is leverage? So leverage in Forex is a way for traders to borrow capital and gain larger exposure to control a larger trade size. So for you guys should know that one lot is 100,000 contract size. You guys know that, right? You guys know that one lot is 100,000 contract size, right? So one lot is 100,000 contract size. So with your leverage, let's say $10, right? With a 1 to 500 leverage, you can play with how much? 10 times 500, 50K. You can open how much? You can open 0.5 lots on gold, right? So this is why leverage is important. It could be a good thing. It could also lead to larger profit, or it could also lead to larger losses as well. So you guys have to pay attention to your leverage. Sometimes with high leverage, yes, you can open more positions, but this could also lead to you losing even faster, which is very, very important. Okay? Okay, now, just before I go on to our price action strategy, is probably the one that you guys are waiting for. This is a very simple thing. How to take advantage of the Forex market, right? You guys have to understand that leverage is in Forex is a way for trader to borrow capital and gain a larger exposure to control a larger trade size. Okay, this is for beginners, right? And number two, we use technical analysis, of course, right? We relies on price charts to identify and critical price level, blah, blah, blah. And technical analysis is all basically what we're going through next on price action strategy. All right. Last but not least, the most important part is money management. No matter what, effective risk management is the key to profitability. Okay. And trading psychology is what you need to ensure that you are successful in Forex trading. Okay, so now I'll go through the one that you guys are probably waiting for is price action strategy. So this is gonna be quite long, right? It's gonna be quite long, so bear with me, okay? Let me remove all the spammers first. Okay, give me 1 second before we go through this. Yeah, I don't know why there's so many. Okay, never mind, let's move on. All right, now we are at chapter 2, price action strategy. So this is a very, very integral chapter and it's a very, very important one for you guys, okay? We put in a lot of effort for this chapter. We took about almost a few days or weeks to come up with all this with actual market representations and example. Okay, we actually put in the effort to do it. So this is what we are going to go through today. So what is price action trading? Okay, you guys have to first understand that it can be considered as a philosophy of how trader can employ different technical analysis and strategies to spot high probability setup. So this is what we call a philosophy, okay? So many people have the misconception that price action trading is candlestick patterns or chart patterns, but it's actually an entire philosophy about how you can employ all your different technical analysis to spot a high probability setup, okay? So if you guys do not know yet, this is what price action strategy includes. There's a lot of things. You have your support and resistance zone. You have your trend bias, your trend channel, candlestick patterns, your chart patterns, multi-time frame analysis, and risk management. So all of these are all included under price action strategy. Okay, so all of this it's not just your candlestick patterns. Okay, so a lot of people have the common misconception that price action strategy is just candlestick patterns. No, price action strategy includes all of this, right? Your SNR, your trend bias, trend channel, candlestick patterns, chart patterns, even multi-time frame analysis and risk management are also part of your price action strategies. Okay, so now moving on to confluence. You guys have to understand that confluence, which is also means confirmation, is the combination of your multiple strategies and ideas into one complete strategy. All right. So you guys already know I've always said this, right? Trading is a game of probability, right? You guys know what does probability means, right? So the more confluence or confirmations you guys have, the higher the probability of a winning trade. So same thing in trading. Let's say if you buy or sell randomly, it's a 50-50 chance. Am I right to say that if you buy or sell randomly, it's a 50-50 chance? So with your different analysis and different confluence, every confluence you add, maybe you from 50, 60, and then maybe you spotted supply resistance zone. This gives your probability 70%. with your other economic analysis, fundamental analysis, fair value gaps, candlestick patterns, you can bring the probability up to probably 80%, right? It's way better than a 50% probability of you just buying or selling based on emotions. This is why confluence or confirmation is very, very important in trading, because trading is a game of probability. Okay. So I'm pretty sure most of you guys know. I will just go through this once more. Common trading slangs. Okay. So long, it means buy. Short is sell. Bulls is buyers. Bears is sellers. So when you say it's bullish, it means that the market is currently in an uptrend. Bearish means the market is in a downtrend. Okay. Bearish. So risk to reward ratio, simplified. Let's give an example. If you risk $50 in a trade to make 150, then your risk to reward ratio is 1 to 3, which means that you basically make 3 times more than what you have risked. Okay, it's very important, but I will go through this another time. Now, understanding candlestick patterns. Okay, this is the most important part about trading, not just price action trading strategy, the entire trading. Why is candlestick important? It's not just candlestick, okay? It gives you the data and the psychology of the market. Okay, it portrays the psychology of the masses in the market. And the common mistake is that people tend to memorize all kinds of candlestick pattern and trading purely off it. Right. When you guys probably started learning, most of you guys probably went to YouTube, look for what's the best candlestick pattern to memorize. What is the name, your morning star, evening star, whatever patterns, right? Let me tell you the truth, okay? It's all based off the same fundamentals of candlesticks. You don't have to memorize so many. Until now, I don't even know most of the pattern name, but I know what does the candlestick shows me. Okay? And the second common mistake is that you're not pairing it with other confluences. You're just trading purely based off your candlestick patterns, which a lot of people memorize, right? They see a doji candle forming. They think that there's going to be a reversal, but that might not happen because you're not pairing it with your other confluences here. And number three, you guys are only using one time frame to determine your candlestick patterns. If you guys realize, every single time frame shows you different candlesticks, right? So in your 1 hour time frame can show you that a doji is forming. But your 4 hour time frame can show you a bearish candle is forming, or engulfing bearish engulfing candle is forming. Your 15-minute could show you otherwise, right? That's why it's very, very important to use multiple time frame to determine your candlestick patterns. Okay, this is the most important part about the whole chapter I will be going through. Okay, so we have to understand what is buying and selling pressure. So your candlestick pattern basically shows you the buying and selling pressure of the market. So a candlestick, for a bullish candlestick, we'll go through the basics first. Okay, so a bullish candlestick is a candlestick that has opened lower and closed higher. So what it means is that it opened at the lows, which is here, right? It opens here and it closes here. So it opened low and it closed high. All right. So what is this? So this low here and this high here is basically the lowest price it reached and the highest price it reached at this candlestick. So if this is a 15-minute candlestick, it means that within this 15-minute time window, this is the highest it reached, this is the lowest it reached. So at the first second of opening, it's here, and when the closure after 15 minutes, the price is at here. All right, this is how you read a bullish candlestick. Okay, now what does the candle body represent? It represents the distance price has moved from the opening price to the closing price. So this is what we call the body of the candlestick. So one thing about body of candlestick is that the longer the body, the greater the buying pressure. Okay, sometimes you guys can see on the real chart. Let me show you the real chart. Okay. I don't know if you guys, okay, never mind. Right. So on the real chart, you guys can see that sometimes there's a lot of bullish candlestick, but not all candlestick have long bodies. Some candlestick, you will see that, the body is short. Some candlestick, the body is very long. Right. So the longer the body, the more the buying or selling pressure. The smaller the body, right? Even if it's full engulfing, right? This kind of small body, it means that there's very little buying or selling pressure. Okay. And now same for the bearish candlestick is the exact same as the bullish one, just that it opened higher and closed lower. Right? The lows and the highs means the same thing as the bullish candlestick. Right. Here's an example for how you guys read the open and low. It's not just like that. You can have candles like this, right? It's the same thing, right? It just shows the open is here and the closing is at the lows, right? It opened high, closed low. And the wicks basically represents where the price rejected of certain areas. Okay, now this is the most important part. Different levels of bullishness and bearishness. I don't need you guys to memorize all the different chart patterns, but I need you guys to memorize this. All you need to know is this, okay? So the levels of bullishness now, first candlestick that we will be going through is our engulfing candlestick. So what is an engulfing candlestick? It's the most bullish candle in the candlestick pattern, and it shows little to no wicks. So you guys didn't see any wick at here, no wicks here. So what does it mean? It represents a very, very strong buying pressure and little to no rejection, right? No signs of selling pressure at all. And the longer the body of the candle, it shows the stronger the buying pressure. So what does it show when you see a bullish engulfing candlestick forming on your chart? It shows that buyers are actually stepping in with huge buy order at this opening price here, right? And sellers are not looking to sell at this zone because there's no rejection here. So when you see this kind of bullish engulfing candle forming, you know that you shouldn't be selling at this kind of candle because there's no sellers are stepping in to sell here. That means it's probably going to sell at a higher zone. So what happens is when you see this kind of engulfing candle forming, it gives you a signal that market can push higher in the long term. In the long term, okay, it might not happen immediately. It just signifies that in the long term, market could push higher, especially if higher time frame candlesticks, right? Like your 4 hour, your daily time frame candlestick closes with such a bullish engulfing candle. Okay, next, for bearish engulfing candle is the opposite of the bullish engulfing candle, right? It's the most bearish candle. Same thing as your bullish engulfing candle, there's little to no wicks, strong selling pressure, right? What does it mean? There's no signs of buying pressure at all because we do not have any rejections, right? We have no rejection at all. It's a straight dump. There's no rejection here. Okay. Same thing. The longer the body, the stronger the selling pressure. And also, it shows that sellers are also stepping in with huge sell orders here, right? And no buyers are looking to buy at this area. So this is how you can interpret candlesticks, right? If you see this kind of candlestick with no wicks, right? This kind of wicks, when there's no wicks here, it means that no buyers are actually stepping in to buy here. This is why I always tell you guys, do not buy or sell on engulfing candles because you can never predict the bottom. So what a lot of people do is when they see this kind of bearish engulfing candle, they step in to buy here. And then what happens? Prices just continue dumping on the way straight because there's no buyers here. So you shouldn't be buying at all, right? Okay, next, we will look at some real chart example of what happens when there is a engulfing candle, okay? So this happened recently when gold manipulated, right? So you guys can see after this bullish engulfing candle form on the H4 time frame here, right, we have multiple bullish engulfing form here and here on the H4 time frame. So H4 is considered a higher time frame analysis. What happened after this, right? You see that prices actually continued an uptrend, but it's not immediately, right? You see, not after this one, it's just gonna go up. No, it actually came down to retest a little bit and then continue going in the uptrend, right? So remember what we talked about earlier is that when a bullish engulfing candle forms, it does not trigger an immediate uptrend. Prices could still come back to retest and continue going up slowly in the long term. Keyword in the long term, right? So same thing, we have another bullish engulfing forming, right? And then after that, prices tend to go up, continuing the uptrend, right? It didn't immediately shoot up like this candle here, but it hints that prices and the market is gonna go up. And then you see prices actually pushed all the way up here. This is how you can identify your trend bias by looking at this bullish engulfing candle forming on your higher time frame analysis. This is how you can predict your how trend is gonna go for the long term, right? So now this is the bearish engulfing candle. So a lot of people, what they did was when they see this kind of bearish engulfing candle, they tend to buy at the lows, right? They tend to buy hoping that prices is gonna reverse. But what happens is, look at this. Instead of reversing, prices just keep continuing to dump all the way, taking out all the buyers. Same thing, a lot of people tend to sell here, people tend to sell here, and then what happens? Prices continue all the way up, right? So when did sellers step in? They only stepped in at this wick here. So remember when we talk about candlesticks, right? Your wicks shows you whether buyers or sellers are stepping in. So these are the things that you guys have to take note on, looking at the wick of the candlestick pattern. All right. So this is why number one rule of candlestick patterns or candlestick, right, is to never ever buy at a bearish engulfing candle and never ever sell on a bullish engulfing candle. All right, do you guys understand this rule? Okay, never trade on a engulfing candle. See, never ever counter trend or trade an engulfing candle. Right? So next we have hammer candlesticks. Okay, this is my favorite candlesticks because it signals reversal, right? So your hammer candlestick is, for the bullish one, is the second most bullish candle. And for the bearish one, it's the second most bearish candle. All right. So for your hammer candlesticks is when you see long bottom wicks like that, right? For the bullish hammer, you will have long bottom wicks. So now, based on candlestick patterns, you guys have to understand what does this candlestick or this rejection means, right? It means that a lot of buyers have stepped in here. Wicks shows rejection. Rejection in this case is buyers stepping in because a bottom wick is forming. So when bottom wick form, it shows that buyers are stepping in to buy up the prices. So what does a hammer shows? Prices, it shows that prices actually open here for the bearish case. So prices open here, prices close here. But it didn't close here immediately. So what prices did was prices pushed all the way down. And then what happened? Buyers step in and push prices all the way up and close here. Right? Same thing for the green color candle here, which is the bullish hammer as well. It opened at the lows, and then prices managed to push all the way down here, but buyers managed to buy all the way back up and close at the peak here. All right, so this is how we look at the bullish hammer. Like I said, you don't have to memorize the name or anything. You just need to know how to read candlesticks. So once more, very simple. If you look at this candle, all you need to know is to understand that long wicks at the bottom here, right, means that there's a lot of buying pressure. That's all you need to know. All right, same thing. For your bearish inverted hammer, this is what we call inverted hammer, which means that there's a lot of long wicks at the top. So this kind of hammer shows that there's a lot of selling pressure stepping in here, right? Prices open here, push all the way up, and then closes below here, right? So as you guys can see, the longer the wick of the candle, the stronger the selling pressure in this case. All right. So this kind of candlesticks are very, very important to identify potential reversal. So for the bullish hammer, it's very important when it forms at a significant support zone, right? So you can see that prices, now let's say we have a support here, right? So prices came to the support, a bullish hammer formed here, right? Bullish hammer formed here. So what does it mean? It means that prices actually got rejected at this point, and then maybe prices came back down, retest, go up. So this is a very, very strong point. Okay, same thing for the bearish inverted hammer. In this case, for the bearish inverted hammer, it's important when it forms at your significant resistance zone here. So when there's a resistance zone here, prices actually go all the way up and then prices rejected here. Right? So this gives you a clue that prices is rejected the zone and is going to probably reject off this resistance zone. Right? So your hammer is a very important candlestick to learn and understand. All right, next. We have some real chart example of what happens after a candlestick. Like you guys can see, a bearish candle form at this resistance zone shows you that prices actually down, right? Prices came back to retest this resistance zone. And then another bearish hammer form, prices continue to go down. So same thing, right? Bullish hammer is the same thing. Bullish hammer hints an uptrend. Okay, now this is your normal candlestick. I will not tap much into it because it's just normal candlestick. Okay, so this is what is the more important one as well. This is what we call neutral doji. Okay, neutral doji candlestick is, you see that there's a very small body, right? So what a small body tells you? Small body means that there's not a lot of buying and selling pressure. Okay, it means that there's a lot of unequal buying and selling pressure because of these long wicks, and usually these kind of wicks are equal, right? This is what we call doji candlesticks. So these wicks shows that sellers are selling as well, buyers are also buying, and then bodies are very, very small because we have equal buying and selling pressure here, right? Equal buying and selling pressure. So the sellers aren't winning, the buyers also are not winning. So when it forms at a significant support and resistance zone, it can signify that your buying and selling pressure is slowing down, right? Because there's indecision within the market. So same as what we talked about for the bullish engulfing and bearish engulfing candle, we do not trade on that. But your doji, this is what you want to wait for. Once you see your doji forming, which we will look at the real-time chart, when your doji forms at a significant support zone, it shows that the sellers are actually slowing down. You can see multiple dojis are forming here, right? Multiple dojis. So what does this show? Like I said before, your candlestick patterns or your candlestick shows you about your market, right? About your market psychology. So you see many of these small doji candlesticks starts to form, and the bodies are all very, very small. The wicks are equal, right? So this shows you or even hints you that after this long selling pressure, prices actually starts to slow down. The selling pressure starts to slow down and consolidate, right? So when it forms at a significant strong support zone, and in this case, it's a very strong one because it's a strong weekly support, prices actually, you can look for buys, especially after this bullish hammer stick, right? Prices came down, rejected, bullish hammer stick form. This gives you another confluence that this could be a reversal, okay? So these are the different kind of doji candlesticks that you guys might see. So we have our normal doji, which is our neutral doji. We have the long-legged doji, your dragonfly doji, your gravestone doji. Okay, fear not. You don't have to memorize the name. All you need to understand is what it signifies. For me, I don't even know the names of this. To be honest, if you show me purely this, I don't even know it's called long leg. You show me this, I don't even know it's called dragonfly doji. But what I know is based on market psychology and how I read candlestick patterns, I will know what it means. Very simple. This kind of doji, it means that market open here, prices push all the way down, buyers step in and close above. That's all you need to know. Same thing for your neutral doji, right? Prices open here, probably push up, push down, and then close back here. Same thing for this. Prices open here, prices push up, and then got rejected and closed below. This is all you need to know for candlesticks. Like I said before, you don't have to memorize so many different candlestick patterns, and there's no point. It's just wasting your time. And as a beginner, you have instead of memorizing patterns, you have to understand what does each candlestick means. What does a small body means? What does your wicks means? All right. So just to go through briefly, your neutral doji signals indecision, right? Indecision. Your long-legged doji is showing you mild buying pressure. All right, your dragonfly doji signifies strong buying pressure because we have a strong lower wick forming. And gravestone doji is the opposite. We have a strong top wick forming. So it means there's strong selling pressure. Okay, so same thing. Doji, engulfing candlesticks, all candlesticks is the same. It's just data to show you about your buying and selling pressure. Okay, so now we'll be going through to my favorite confluence now, support and resistance. All right, so support and resistance is the same as supply and demand. So a support zone is also a demand zone. Resistance zone is your supply zone. If you guys are confused, okay? If you guys are confused, one more time, support is the same as demand, right? Demand is when people wants to buy. Same things for support. Your resistance is your supply, is where people are looking to sell at. This is your supply zone. All right. So this is one of my best confluence and strategy used to determine reversal or continuation zone, right? So these are very, very important zones to look out for, especially for support and resistance, right? If prices are not within or inside my resistance or support zone, I will not trade at all. This is a confluence that I must have in my trading plan or any trades that I take. It has to be within a support or resistance zone. I will not take, let's say when prices are in the middle here, prices are here, I will not look for any trades at all because I do not know if prices is going to go down or go up, right? I want to wait for prices to tap my resistance or tap my support zone for buys here, right? So common mistake. Another common mistake is over-reliance on your support and resistance zone. So many beginners, they tend to sell at resistance and buy at support. In the next example, I'll show you why that is not the case, okay? So a lot of people, same thing, right? They see this kind of chart forming, they will tend to buy every time prices steps back here, and then they tend to sell when prices step back into the resistance zone, right? The thing is, you might be lucky, right? Maybe your first 3 times when it tests the zone, you might be lucky, you might caught the sell, you might have caught the buy. But what happened is sometimes prices, for example, this was a resistance zone, right? The third time, prices actually broke through all the way. So if you sold here, your stop loss would have been taken out. So a resistance zone might not always hold. Same thing, a support here, it retested 1 time, came back to retest, 1 more time, 2 times, came back to retest 3 times. What happened at the 4th time, prices actually broke through very, very strongly, right? This is why you cannot over-rely on your support and resistance zone. It should be used as a confluence, but remember, we have to have as many confluence as possible to increase the probability of our trade. So what do you guys have to look at, right? So before we even enter a buy on our support zone, we have to look at candlesticks, right? I would buy here because we have hammer candlestick, bullish hammer candlestick forming and a bullish engulfing forming above the support zone. So I will look for buys here. But this time, why would I not look for buys? Is because you see that there's a lot of selling pressure here. and prices did not show any form of rejection. This is why I didn't buy. I will not buy at this support. Same thing here, right? You see that prices actually rejected. And what is this? This is a strong bullish engulfing candle. So when you see an engulfing candle, you do not want to sell at all, because as you guys can see, this engulfing candle has broken through the entire resistance zone, right? This is why you have to always monitor your candlestick patterns within your support and demand zone, or supply and demand zone, or support and resistance zone. All right. Okay. Next up, we have our trend channel. This is also very important because identifying your trend bias helps you to focus on giving high probability trade that is in line with your trend. All right. So we have three major types of trend channels. So the first one is the uptrend. The second is the downtrend and the sideways channel. So we're gonna go through slowly, right? And this is pretty clear cut, right? So uptrend is basically is prices are moving upwards in the market. Prices are bullish. Downtrend, prices are bearish. Horizontal is what we call a ranging or consolidating market. All right, so here's some real chart examples and how you can do take entries here. Okay, so in the uptrend channel, do you guys know how to plot an uptrend channel? So usually when you plot an uptrend channel, do it on a higher time frame, like maybe 4 hours, right? If you do it on maybe 15 minutes, right, it's not going to show you anything. So when you go and plot your trend channels, go to 4 hours or daily to plot your trend channels, and it should at least have 2 peaks and 2 bottom throws here, right? So it has to touch at least 2 peaks. So in this case, we have 3 peaks and 3 troughs, right? So from here, I do not want you guys to buy every time it touches here, or touches the support band, or sell every time it touches the resistance band. All right, this example is just to show you guys how people usually trade and how you can possibly trade. But like I said before, every single time you want to look for an entry, do not trade purely based off your support band or your resistance band here, right? So let's say it's currently touching your lower support band of your trend channel, doesn't mean you're going to buy here, right? Sometimes prices could continue breaking out and break out of your trend channel. This is why you should always monitor price action within the zone here. Same thing, right? You want to monitor price action here. If you see a big bullish engulfing candle popping out of this trend channel, are you going to look for sales? No, right? So you have to look for resistance from here to look for sell. Same thing, you have to look for prices rejecting off this. Best if you see this kind of bullish engulfing candle forming, then you know that prices has actually rejected off this. All right. Always look for multiple confluence. Do not trade just based off your support resistance, or in this case, your support band or your resistance band. Okay. Do not trade blindly. All right. Here, do not trade blindly. Okay. Next, in a downtrend channel, like I said before, prices are always creating new lows and lower highs. All right. So in the downtrend channel, if you guys realize, this was the peak, and then prices are creating new lows, lower highs, lower lows, lower highs, and lower lows. So like I said before, all the concepts are similar to one another. So you guys have to understand this fact first before you even look to trade price action. So the same thing, in a downtrend channel, you see that prices are actually making new lower highs and lower lows. And to plot the trend channel, same thing, you need a minimum of 2 peaks and 2 troughs, right? And the upper resistance band and lower support band has to touch at least 2 points, right? In this case, we touch 2 points. Okay, so there's 2 ways to trade trend channels. So number 1 is you look for selling opportunities at the upper resistance band, or buying at the support band here. Number 2 is trading breakouts, which we'll get into later on. Okay, so number 1, we will look at the real chart example here. Okay, for the downtrend channel, the real chart example is, look, I'm not selling this just because it actually rejected off the upper band. But in this case, I actually sold here because I have 4 confluence. So the first confluence is that we have a bearish hammer forming here, an inverted hammer here at this upper resistance band. So it shows me that sellers are stepping in. All right, number 2. Confluence number 2 is that prices rejected our horizontal resistance zone as well. Right, so this is our horizontal resistance zone here. And then the third confluence is that our trend bias is bearish. So looking for sells is safer than looking for buys. All right, so confluence 4 is that, look at all these candle bodies getting smaller and smaller as we reach our resistance. So this is the 4th confluence to show that buying pressure are actually slowing down. And this is when I will look for sells. when it touched my resistance band. All right, up to now. Are you guys still following with me? Okay, next we have our sideways and horizontal channel. Okay, this is the simplest. It's just basically your normal support and resistance band. Okay, this is the simplest of all. It shows that prices are ranging between a clear support and resistance zone. And usually, if you guys realize, this tends to happen right before a big news. If you guys realize, this tends to happen right before a big news. So prices are always consolidating within a sideways channel. Okay, accumulation is also called an accumulation. And then usually when news release, you will see a big breakout. This always happens, okay, before a big news on the lower time frame. Yes. Okay, so this is what you can see, right? Prices actually range between this clear resistance and support zone here. All right. So when you want to trade breakouts, like I said before, breakouts doesn't mean that you're going to sell at resistance and buy at support. Sometimes you can buy it when it touches resistance. Okay. So I'll show you how we can do that. So as you guys can see, this is our support zone. This is our resistance zone. It's a very clear support and resistance zone here. Prices has been ranging here for multiple days. And then suddenly, prices actually broke out of this zone. Right? So what are the confluence I look at when I trade breakout? Okay. So number one, resistance zone has been broken with a bullish engulfing candle. Okay, this is not really a bullish engulfing, but this is very strong buying pressure. It's more of a hammer mixed with engulfing. Okay, so at least this candle shows you that we have a strong bullish momentum breaking out of this resistance. So when you see this kind of candle breaking out of the resistance zone, it means that there's no more sellers here. Buyers has completely taken over this zone. So when a resistance zone gets broken through, it becomes a support zone because sellers have left, buyers has taken over control of this zone. So this became a new support zone. Okay, so our confluence too is that this candle actually hold and printed above this whole resistance zone, right? Signifying your strong buying pressure. And number three, right? We are also currently in the uptrend. This is basically a cutout, but we are in an uptrend channel, right? Now, it broken out of our horizontal zone, and it actually also broken out with an engulfing candle above this upper resistance band inside our uptrend channel. These two lines is actually from our uptrend channel above here, right? This part is the zoom in part of this. Okay, so a lot of people will start to look for sell here. This is a common mistake, right? Because they see that prices has pushed up so much and it's actually resisting our top resistance band of our uptrend channel. But you guys have to realize this. We are currently in a strong bullish momentum and a strong bullish trend. So our trend bias is already determined by an uptrend. So looking for sales is already considered risky, right? So what we should be looking for buys opportunity because we are in an uptrend. So trend bias is very important in this case. So this will be one of the confluence. And number two is that we have already broken out of our consolidation zone with an engulfing candle. So now, this bullish engulfing candle has actually printed above our upper resistance band, and confluence 3 always enter above after your retest. You do not want to enter here because prices could immediately dump down. So what happens is the next candle actually pushed up, prices retest, we can look for entries upon the retest. So this is how you trade breakouts. Okay, I will show you another example in this. All right, so you guys can realize we have a clear support and resistance. So when is the best time to trade breakouts? Is that when you see that prices are actually in a ranging or sideways channel, it's the best time to look for trade for breakouts. Usually in after an accumulation, when you see a resistance get broken through, it's usually a breakout candle and then we have an uptrend. Or a support get broken through, we have a downtrend. All right. So I'll go through some of the confluence I look at when I'm looking for breakout. Number one confluence, I have to realize that we are in an accumulation phase. So what am I aiming for is breakouts, right? So my confluence one is we have a breakout candle forming. This is a very strong bullish engulfing candle here, right? A strong bullish engulfing candle forming here. And we have a full closure above this horizontal resistance zone here. This already shows that we have zero sellers here and buyers has taken over this entire resistance zone. This whole zone, buyers has taken over this zone. So confluence 2, your breakout candle must close above your previous high, right? So this was your previous high here. Not only we broke out of the resistance zone, we broke structure by breaking above our previous high, creating a new high here, right? Confluence 3, remember, do not trade immediately after this. We wait for a retest. So like I said before, when a resistance gets broken through, it turns into a new support zone because buyers has taken over this zone, right? Buyers has taken over. So now it becomes a new support. So when prices tap back, do not enter immediately. Always wait for candlestick patterns. So what do you see here is what we see is a small doji candle forming. And actually we had some sellers coming in strong here, but this doji form showing that indecision, right? And this is a new support, fresh support zone. So this is where we could look for entries because of this big candle here. So if you guys learn SMC and ICT, this candle here is also what we call an impulse or institutional candle. All right. Okay. So how do you guys identify a trend bias? So what is a trend bias? So you guys have to refer to the overall direction and sentiments of the market. So this is what trend bias basically means, right? The overall direction and sentiment of the market. So very clearly, if you go to your higher time frame chart, you can see a very clear trend bias, either an uptrend or a downtrend. So how do you guys identify whether it's in an uptrend or downtrend? Okay, I mean, in a dumb way, you see that it's just keep going in continuously up, then there's an uptrend. But you guys have to realize to continue an uptrend, prices have to create higher lows and higher highs. So to create a higher low and higher highs, you guys can see from here, we have the start of the uptrend, right? This was the higher high, prices came down, higher low, higher highs, higher lows. So when does an uptrend gets broken down? Okay, an uptrend will be continue as an uptrend as long as the previous higher low does not get taken out. So let's say if this candle closes below this previous higher low here, candle closes here, we've broken the previous higher low, this signals the end of the uptrend. So this is where there will be the possibility of a reversal. Okay, same thing. When we identify a downtrend, what we are creating is lower high and lower low. So as long as prices does not break above this previous lower high, if prices breaks above here, that means it's a reversal, right? So from here, that means it's the end of the downtrend. So as long as prices doesn't break, so let's say prices does not break above this previous lower high, we are still in a downtrend. All right, make sense? So and here, right? So bearish bias continues as long as the next swing does not break the previous lower high created. So this is very, very important, right? This is the fundamental for your future SMC and ICT, right? Which I'll be going through in the next lesson. Your SMC is your change of character, right? Or your break of structure. Your ICT is your market structure shift. So this builds up the fundamental for that. All right. Which time frame? Good question. Identify your lower high and higher low. It can be identified on every single time frame. But what I would recommend is for scalper, look for H1. H1. For swing trader, look for at least H4 or daily time frame to show the general trend of your market. All right. Higher time frame. Do not look at your 5 minute, 15 minute. Okay, it's not going to show you the long-term trend. All right, look at your higher time frames. 4 hour and above is the best. Okay, now, so I will show you in a bull market what happens. Okay, this was actually at 1,008, 1,600. This is for gold. It pushed all the way to 2,000s. Okay, so this is a very strong bullish market because if you in SMC, it's a lot of break of structure, but I'll just do it in terms of price action. It's the same concept, right? So what happens was actually it created higher lows and higher highs without any market structure shift. That means the previous higher lows didn't get broken at all. So what happens is it forms like that, right? So continuous is a continuous motion. So the new higher low form is always higher than the previous higher low, right? Prices didn't break below here. So as long as prices didn't break below this previous low here, prices didn't break below this previous low, prices didn't break below this previous low, we are still in an uptrend. All right, that means we should be still looking for buys until suddenly, let's say prices breaks our low here. Okay, so what happens is, this is an example, okay, of how do we know when the trend bias has changed. Okay, so here, we are currently have a downtrend here, creating lower low and lower high, right? And then after that, we have accumulation phase. So how do we know that prices reverse? We have a change of character here. In SMC, or what they call a market structure shift in ICT. All right, so we have a bullish engulfing candle breaking above this previous lower high here. So this signals the end of the downtrend and a potential reversal towards an uptrend. Okay, so this is a potential reversal. So yes, how do we know if this is a higher probability, right, order block or a break, or is this a clear break of the previous lower high? This is when your candlestick come into play. This is why you have to look at your candlestick. It's very, very important. So when you see this kind of big bullish engulfing candle breaking above your previous lower high, it gives you a very strong confirmation or confluence that buyers are in full force here. And if it breaks your previous lower highs, that means there's no more seller left in this resist. If you guys know that, if you guys can see, this is also a resistance zone, right? So it broke this resistance zone and previous lower high with a bullish engulfing candle. This already gives you a clear confirmation that we have a clean change of character, right? Your buying and selling pressure, like I said, very important, right? It always comes down to your candlestick because it gives you data on the market psychology of what the market is thinking. So when you guys want to look whether it's a high probability or low probability trade, look at your candlestick. Okay, so you guys can see from here as well. After this, we have an uptrend, right? A reversal to an uptrend after the downtrend has ended. So in this new uptrend, we are creating new higher lows and higher highs, right? That means prices did not break the previous lows at all. Okay? Okay, now chart patterns. Personally, I do not use much of these chart patterns, but it might be good for you guys to understand this, okay? For me, I don't really use this because it's all based off support and resistance zone, lah, right? If you guys understand the fundamentals of the market, it's basically support and resistance. Okay. But symmetrical triangle, ascending, descending triangle pattern, and head and shoulder pattern, I'll be going through this. Okay. I'll be focusing more on number 3, because number 1 and 2 is mostly support and resistance. Okay. So your ascending triangle pattern, if you realize this, we have a clear resistance level. Just that this support is not a horizontal one, it's a ascending support, right? But if you guys realize, we have a support here, lah. So it's about the same thing. So this is actually a support zone here, resistance zone here. Okay? Just that from here to here, this point is an ascending support level. So how do you trade? It's usually to look out for breakouts when prices break above your resistance zone. Okay, same thing for descending triangle pattern. You have a clear horizontal support and a descending resistance. It's the same thing. If you guys realize, it's actually a resistance zone being formed here. Actually it's all the same, right? It's all built upon your fundamentals of support and resistance. So all your chart patterns, all your trend biases, they're all actually the same thing in your different concepts. Alright, so same thing for this descending triangle patterns. We are looking for a breakout trade as well, just that this is a bearish breakout candle trade. Okay, symmetrical triangle pattern. Okay, this is a little bit confusing for you guys, but I'll just go through. A symmetrical triangle chart pattern is a continuation chart pattern. Okay, so sometimes if you realize after a big impulse breakout like this, right? Yeah, so this kind of triangles pattern is good because usually it's consolidating to a certain point. And then when you see a breakout at this certain point, it's good to identify. It's a very good chart pattern for you to identify breakouts. Okay, so for symmetrical triangle pattern, it means we have a descending support, descending resistance, and then ascending support. So it's connected to this point here. So it shows, if it shows that, it's breakout to the downside or an upside. So it's good to trade breakouts. But how do you use this, right? Number 1, always follow your trend bias. Okay? Always follow your trend bias. So in this case, we have a big institutional candle here. So we should look for buys breakout. So if in this case, if prices actually break out towards the downside, will you look for sells? For me personally, I wouldn't, because we are currently in an uptrend and it's risky to trade against the trend. Okay, next. This is the more important pattern that I want to tell you guys. It's what we call the head and shoulder pattern. Most of you guys could have heard about this pattern, and the common mistake is that most beginners tend to use or identify these patterns on 5-minute or 15-minute chart. But trust me, it's not gonna work. Okay. Look for your head and shoulder patterns on your higher time frame, like a 1 hour, 4-hour time frame. Okay. So the head and shoulder pattern is a bearish reversal pattern. Alright. So when found in an uptrend, it signals the end of the uptrend. If you guys realize, it's the same thing as higher highs, higher lows, and then prices couldn't break above the higher highs here, right? Prices could not push up and break it. Instead, it actually broke below this previous swing low here. So there's a market structure shift or change of character here. Okay, this part I will briefly go through. So what happens is that your left shoulder here, is where sellers come in, right? So prices push all the way up. Sellers start to come in here. Prices sell down, created a new higher low. Prices managed to push up all the way to create a peak here, right? Push through to new highs. This is your head. So this is your peak because why? Your right shoulder here didn't close above here. So the new highs are quickly turned back and the downside is tested again. So what happened is prices came back down, prices push up and got rejected. Didn't manage to push above the head, right? So now prices actually push below and break below this previous swing low here, higher low created here. So we have a market structure shift here. All right. So what is important is to look for this pattern on higher time frames, such as your H4 or your daily, to identify the long-term trend pattern. So this neckline is basically your support, if you guys realize. So there's a lot of different concepts, different names, right? So after this video, you guys probably learned that it's all similar concepts combined into one big trading plan together. So all these small little confluence and strategies is all actually linked up into one gigantic trading strategy or trading plan. So here's on a real trading chart. As you guys can see, we have an ascending support, right? Which is your neckline. Or if you guys want to play safe, we can also look for an horizontal support here, right? It's the same thing. Prices break through the horizontal support, it turns into a resistance. But okay, same thing I'll go through on a real chart. The first high made, so this is your higher high, right? And then prices came to create higher low, higher lows, okay? And then prices push all the way to your head, creating a new higher high. And then what happens is that it's still a head and shoulder pattern because prices created another higher low. So this higher low did not break below this higher low. So this is a new higher low created. However, the right shoulder from here, this right shoulder, didn't break above this previous higher high. So this is not considered a higher high. So this is not an uptrend anymore. So in this case, we have a complete head and shoulder pattern forming because the right shoulder did not break above the peak here, this higher high here. So what happens is that we have a potential reversal forming. So what is good is to identify a resistance zone. We have a resistance zone if you guys realize here. And then you guys can see that it rejected off this resistance zone as well, right? So we have two confluence, head and shoulder pattern forming, rejected off the resistance, and we have a gigantic engulfing candle here. So like I said, you don't want to trade on this kind of engulfing candle. These are what we call an impulse candle. So what you want to do is to wait for prices to retrace, right? Retrace upwards, come back, prices retest the neckline, and then you can look for your sales entries. All right. So your neckline is to give you a gauge of whether we are still inside our trend or not. Okay, now inverse head and shoulder pattern, I will not go through very thoroughly here, but it's the opposite of your head and shoulder pattern, right? It's to signal a bullish reversal. So head and shoulder pattern signals a bearish reversal at the end of an uptrend. Your inverse head and shoulder pattern signal end of a downtrend. So if you guys realize this, right? Same thing. Remember your higher highs and higher low, this time it's lower high and lower low. So your lower low has been created, right? Your lower highs, lower low, and then lower low created, lower highs created, right? And then your right shoulder didn't manage to break below your previous lower high created. So this shows that it's really a confluence for potential reversal here. Alright, and then when prices break through your resistance zone, which is your neckline here, with a bullish engulfing candle, it really signals a strong reversal. So now we have how many confluence? We have one confluence. You see prices actually didn't break below this previous lower high. This is one confluence, forming the second shoulder. Second confluence, prices break above this support zone. Third confluence, prices break above this resistance zone, and then our third confluence, a bullish engulfing candle has broken through. Fourth confluence, prices retest with a hammer candlestick, right? So these are so many confluence being put together here. That's why you can look for a entry here. This is why do not trade purely just off the pattern. You have to look for different confluence, your candlestick, your support resistance zone, your chart pattern. You can even look for triangle pattern. If you guys realize, we have a mini triangle pattern forming here, right? And then we have a breakout out of this triangle pattern, right? So these are all the things that you can look out for. It's very, very important to understand, to combine all of this into one complete strategy. This is what price action is all about. Okay, now simple already. After this is all simplified, okay? Double and triple top, this is very easy, okay? It's just prices has tapped the same zone multiple times. 3 times means triple top. Tap this zone 2 times, it means double top, okay? Same thing, double and triple bottom. It's like your support zone. It's the same thing, just that it tapped it twice. But double and triple top chart pattern is more useful on a higher time frame, is to show that there's a lot of rejection on the higher time frame. Okay, now this is something that I really want to enforce on, and it's something that is very, very, very important. Is your multi-time frame analysis. Multi-time frame analysis is super duper important. Why is that so? Because different time frame shows different market bias and candlestick patterns. Like I said before, different time frame give you different data, right? Different data give you different candlesticks. Your candlestick is data of the market psychology of the buyers and sellers, your buying and selling pressure. So different time frame shows you a consolidated data over a certain different period of time. So multi-time frame analysis is very important of all style. No matter you're a swing trader or scalper, multi-time frame analysis is very important. Okay? It provides a coherent and actionable view of the entire market structure, not only your lower time frame, or your long-term trend as well. If you guys realize on 15 minutes it could be an uptrend, but on the 4 hour it could be in a downtrend, right? So always consider multi-time frames, okay? It's not always, it's a must to consider multiple time frame in trading. Even if you have a preferred time frame, let's say your favorite is H1, 1 hour, you always trade on 1 hour, okay? Please look at your 15 minute as well, look at your 4 hour, your dailies as well, because all of these different time frames can provide you useful information and a clearer overview, right? Your H4 can give you a significant support and resistance zone on the higher time frame. Okay, so rule of thumb, please at least 3 time frames in the minutes, hour, or daily chart, and all have to line up. Okay, so let's say your 15 minute shows that the bias is probably a downtrend, but your H1, H4 shows it's an uptrend, but daily is a downtrend. So this is what I mean by it doesn't lines up, right? Because different time frame shows different trend bias. So this is when I will take a step back, and then I will not look to trade. I will only look to trade when all my different time frame, my minute time frame, my hour time frame, and my daily time frame all shows the same bias. Let's say in the case all shows that it's bullish, right? Then I will look for buys. All right. So if one is bullish, one is bearish, then one is bullish, it's a lot of mixed answer, right? So this is when I'll wait until I have a clearer direction of the market before I trade. This is why multiple time frame analysis is so important, and it's one of the best strategy that I personally use. Okay, so now, last but not least, it's always the most important, okay? I put the most important at the last before we end, is that we have to realize the most important aspect of trading is proper risk management and trading psychology. Risk management is the most important thing in trading. And technical analysis is only 30%. Okay, your fundamental, technical, economic, psychological, whatever analysis you do is only 30%. The other 70% comes from your risk management and trading psychology. If you guys realize, you guys always make the right analysis, right? You know that prices are going to go up. But what happens is, because of your emotion, you guys tend to close your trade early. Instead of hitting full profit level, you guys only take 10, 20 pips profit. Or sometimes even worse, you guys let it run to your stop loss, busting your account, and then finding out that it actually moved towards a take profit zone, right? These are things that should not be happening, okay? And this is just a rule of thumb, that is to not risk more than 2.5% of your account per trade, and at least have a 1-to-1 risk to reward ratio, okay? At least have a 1-to-1. And almost there, last but not least, okay? Now that you have learned all the candlestick patterns, your chart patterns, your multi-time frame analysis, risk management, and support and resistance zone, I want you guys to promise me that look for at least 3 to 5 confluence before looking for a trade, a high probability trade. A high probability trade is what I'm looking at, maybe at least more than 5 confluence, at least 3 confluence. If you don't even have 3 confluence, do not even enter your trade. You're trading based off emotions. And what I mean by confluence is not you entering the trade and then finding your confluence after you have entered the trade. Okay, this is lying to yourself. I want you to actually plot it all out and write down. Okay, for those of you guys here, write down what confluence you are looking for. And when price action moves in the live market, forming the confluence that you're looking for, let's say for example, it's reaching your resistance zone, right? Your trend bias is a sell. So now it reached your resistance zone. Now what you're looking for next is a rejection at the resistance zone. So now we have 3 confluences, right? And then you do your economic analysis, maybe your fair value gaps, your liquidity sweeps, everything. It gives you your 5 confluence for a high probability trade. Okay, so at least 5 confluence. Okay, please do not lie to yourself. Do not enter the trade and then try to pray that your confluence align. Write down your confluence before you even enter the trade, and wait for prices to check off the boxes of each confluence before you enter the trade. Okay, now finally we're at the end of this long ass meeting. So summary of the key points. Okay, understand your candlestick patterns and buying or selling pressure. Number two is to identify the trend, whether it's in an uptrend or downtrend. Never trade against the trend. Okay, for some people, when you're more advanced, you guys can do counter trend scalping, hedge liquidity sweeps. But for beginners, then try not to trade against the trend. Okay. Number three, analyze on larger or multiple time frames. At least one time frame in a minute, hour, and daily. Okay. For me, personally, I like to look at 15 minute, 4 hour, and the daily. You guys can follow suit if you guys want. And four, minimum three confluence. Minimum three confluence. Best if you have 5 confluence before you enter a trade. Number five, important, okay? Always plot significant support and resistance zone on higher time frame first before plotting the minor ones. So you go to your H4, your daily, you plot out your daily resistance, daily support, H4 resistance, H4 support. Then you go into your hourly and your 15 minute to plot. Because usually your 15 minute and hourly time frames tend not to hold, if you guys realize. Right? So a lot of people, especially for me, when I started trading, I tend to look for support resistance on the 15 minute and 1 hour, and most of the time it just got broken through, right? So look at a higher time frame. Number six, look out for candlestick patterns and momentum. Okay, very, very important. Candlestick patterns and momentum. Momentum showing your buying and selling pressure near your support and resistance breakout or reversal area. All right. When prices are reaching my significant zones or significant area, which I'm looking to look for a trade at, this is when I will monitor my candlestick patterns very, very carefully. All right. Number seven, look out for channels and chart patterns that are forming to trade breakouts. So when you are looking to trade breakouts, right, like you already know that you want to trade a breakout. This is when you look out for your channel, your chart patterns, and this will tick off your extra confluences to look for your breakout trade. Number eight, when entering a trade, wait for a retest. Always be patient, right? You guys don't want to hurry, fear of missing out or FOMO into a trade. Always be patient and wait for a retest. Let's say if it doesn't retest, it's a straight way up, it's okay. Because market will never move in the uptrend all the way. They will always have pullbacks before continuing up. So all you need to do is to catch the pullback. If you miss out on the initial entry here, it's okay. You can always look for a second entry here. It's always better to miss out on a trade than enter a losing trade. All right. And number three, always look for bullish or bearish engulfing confirmation candle. Okay, this is not counter trend. Okay, confirmation candle. So if you want an uptrend, okay, you guys need an engulfing candle to print above a resistance zone, a bullish engulfing candle to print above this resistance zone to confirm that it has broken to the upside. Then when the prices come down to retest, you can look for buys here. Number nine, do not rush into a trade. Okay, do not trade on long breakout candles, engulfing candles. Trade on the retest. So what do I mean? Do not trade on this kind of candle. Do not sell here, okay? Do not buy here as well. You want to buy at the retest or wait for doji to form on top, then you look for your sells. Okay? Number 10, risk management. I have to emphasize this the last time, okay? Risk management. Do not risk more than 2.5% of your account per trade. Okay, please. If you risk 2.5% of your account per trade, even if you lose 20 times in a row, you will still have 50% of your equity left. All right? So this is basically what I have. Okay, to end off, last thing, a word of advice for you guys, okay? Very, very important. Instead of going from searching your best holy grail from the best spot, from the best indicator or the only strategy you need to be profitable, these kind of videos online, right? Why not learn to be adaptable and craft your own best trading plan that works for you? And work on your own trading psychology first instead of wasting time hopping from one to another. So instead of learning or trying to copy the best trading plan or best trading psychology or best trading indicator online, why not find and craft your own one? Use this time chasing useless things. I wouldn't say useless, okay, chasing things. Why not use it to work on your own plan? Because in the end, the plan might work for others, but it might not work for you. Why am I successful or profitable is because I use my time to look for my own strategies, right? I learn all my different concepts and then I build my own trading plan that is most suitable for me. This is why I'm profitable. But my trading plan might not be profitable for you because I have maybe because I'm not working a full-time job, I can trade multiple time zones, I have higher equity margin, things like that, right? That's why it might not work for you. I have higher risk tolerance, right? So you have to find the one trading plan that works the best for you. So let's say you're a full-time, you have a full-time job, you can only trade after work, right? Then you have to craft a trading plan that can adhere to that, right? Maybe you don't have big equity to risk. Maybe you can only risk small amount of money. then create a trading plan with tighter risk management. All right. So with that, thank you everyone for joining. Right, we are done with chapter 2, and the next chapter will be chapter 3, ICT and SMC concepts. Okay, but we'll be going through that probably next week. All right. So I'll leave it to you guys with this word of advice, and thank you everyone for joining. Okay, see you guys on the next one. All right, next week we're gonna try to catch some great peeps. Okay, since all of our everything is done. All right, see you guys.